London's GDP per capita ranks among the highest in the world, on par with entire countries, while regions like the Northeast produce less than half that per person. Same country, very different economies. This isn't just regional inequality. It's a blueprint for collapse disguised by one city's glittering success. By the end of this video, you'll know how that gap affects jobs, house prices, and your bank balance, and one practical step people can take today. To understand how we got here, we need to look back at a time when the UK still believed its economy was unstoppable. From empire builder to economic warning sign. At the turn of the millennium, the UK still looked like a confident economic story. Growth was steady, trade volumes were expanding, and the pivot from heavy industry to a services-dominated model seemed like it might deliver lasting prosperity. That sense of momentum has since faded. Growth has been weak and uneven in recent years, with only modest quarterly gains, such as around plus 0.3% in Q2 2025, and a productivity record that continues to lag many peers. What was once a model for economic reinvention is now more often cited abroad as a warning about what happens when an economy is left to drift. The contrast is stark for a country that once built rail networks overseas, dominated global trade routes, and shaped financial systems that others copied. The shift hasn't been dramatic enough to trigger a crisis headline, but the long-term erosion is visible in the statistics. Productivity per worker has slipped steadily down the international rankings, with each hour worked in the UK now generating less value than in France, Germany, or Canada. The OECD continues to record a widening gap. Real wage growth for most workers has been flat since the global financial crisis, and living costs for essentials repeatedly outpace pay packets. The OBR and other analyses have noted that Brexit and persistent underinvestment have kept productivity several percentage points below where it otherwise could be, a drag that compounds year after year. Too many short-term political moves, tax headlines, brief incentives, and start infrastructure, added up into structural underinvestment. The result: weak productivity and flat real wages for many. ONS data and economic briefings confirm that weak improvement in productivity is now one of the most persistent features of the UK economy in 2025. It's not a single policy failure, but a pattern, repeated across governments, of favoring immediate boosts over long-term stability. Much of the political conversation still leans on an older national image, flattered by the UK's mid-20th century influence and reach. That nostalgia softens the perception of weakness, creating a belief that the country's stature alone can buffer against stagnation. But the numbers tell a different story. Output per head barely growing, high-value exports losing ground, and investment in capacity concentrated in narrow sectors rather than spread across regions and industries. If you looked only at certain sectors, particularly finance, you could conclude Britain is still strong. Yet that concentration is part of the problem economists highlight. Growth driven by a small cluster of industries in a small geographic area hides the fragility elsewhere. When these sectors underperform, the lack of balance in the economy becomes painfully clear. Domestic consumption growth has been slow because wages remain static and productivity improvements have largely stalled. Gains in the capital have not translated into broadly shared prosperity. This pattern, initial success in drawing investment into finance, the gradual hollowing out of manufacturing and regional industry, and reluctance to diversify, is now part of policy case studies on how an economy can falter during the shift to a high-value service model. Other countries facing similar transitions have made deliberate moves to lift skills, attract varied industries, and spread investment. In the UK, successive governments have maintained a narrow focus, preferring to reinforce already dominant sectors. When political cycles demand quick results, decisions trend toward the expedient. Tax cuts without the fiscal space to support them, incentives that favor property over productive business investment, and austerity phases that cut into infrastructure and education have all contributed to the current malaise. Each choice was defended at the time as sensible or necessary. Together, they traded long-term resilience for temporary gains. By the middle of the 2020s, this approach has produced a kind of managed stagnation. GDP growth remains low, not as a momentary dip, but as the baseline expectation. Workers face rising costs for essentials such as energy and transport without corresponding income growth. Policy-induced barriers still limit the spread of productivity gains, from delayed infrastructure upgrades to outdated education, priorities that fail to supply skills in emerging fields. The challenge is persistence. Countries hit by sudden shocks sometimes use the disruption to overhaul their economic models. Britain has slid too gradually for that kind of reset. Politicians speak of opportunity and leadership, but the underlying measures, output per capita, share of high-value exports, productivity growth, continue to weaken relative to most peers. Internationally, Britain is now less a template to follow and more a cautionary chart in comparative economic analysis. Where its deregulation wave once set trends, the UK is now often used to illustrate the risks of overdependence on a single growth engine. Economies with smaller financial hubs, but more even regional development point to Britain as proof that headline GDP from one city cannot disguise structural imbalances forever. In teaching materials and consultancy reports, the UK's early 2000s trajectory appears as a promising launch that plateaus and then falls behind peer averages. Decline here didn't come with a crash. It unfolded quietly, with each year of modest returns compounding the gap. Leaders and media attention often gravitated to isolated successes. A strong quarter in the city, a major tech listing, a new trade announcement, while the overall trend continued downward. And at each stage, there were opportunities to act differently. Targeting investment to boost productivity in underperforming regions, developing new sectors alongside finance, or updating education to meet future rather than past demands. Instead, the choice to double down on the country's most lucrative sector has been deliberate and sustained. It has produced the appearance of stability, but also deepened vulnerability. By 2025, the indicators that once signaled room for course correction have shifted into confirmation of long-term underperformance. Even optimistic forecasts struggle to put the UK back among the leaders within the current model. And while there are still clear centers of exceptional economic activity, their strength also makes the imbalance more pronounced. The concentration of growth, investment, and opportunity in one place sets the stage for the next, sharper contrast between the fortunes of the nation as a whole and the performance of the capital. London's glow, nation's shadow. In 2025, London still punches far above its weight. It ranks among the world's top financial centers in foreign exchange and wealth management, and City of London figures show financial services remain the UK's leading service export, generating roughly $160 billion in revenue in 2023. That scale of activity feeds directly into the national accounts and props up the government's fiscal position. When measured separately, London's per capita GDP rivals entire countries. The rest of Britain lags far behind, with many regions still yet to regain pre-pandemic productivity levels. Move away from the capital, and the contrast is immediate. In parts of the Northeast, Midlands, or coastal towns, private investment can be close to non-existent. High streets carry more boarded-up windows than open shops, and in some areas, employment never returned to pre-2008 levels. ONS data shows clear disparities in GDP per head, median incomes, and even population growth patterns, with younger workers leaving for jobs in London or moving abroad entirely. London's position in the global finance hierarchy is deeply entrenched. Only New York consistently ranks higher overall, and in some niches, such as foreign exchange trading, insurance underwriting, and legal arbitration, London still leads the world. This status draws in international firms, attracted by its regulatory framework, time zone, and dense concentration of specialist services. These headline strengths shape the way Britain's economy is perceived abroad, masking the picture on the ground in much of the country. Beyond finance, the story changes. Manufacturing output now occupies a smaller share of GDP than at any point since industrialization began, and hospitality faces closures under the strain of higher energy costs, persistent staffing gaps, and weaker domestic demand. Retail in many towns is reduced to a handful of supermarkets and charity shops. Local councils in post-industrial regions operate under restrictive budgets, unable to fund the kind of regeneration projects that might reverse decline. If you average all this out with London's figures, it can distort the national story entirely. The structure of available work reflects the divide. In the city, demand for analysts, compliance specialists, and fund managers stays high, with salaries well above national medians. In smaller cities or rural areas, available roles tend to be short-term positions in care, warehousing, or hospitality, with hourly pay rates barely advancing in real terms over the last decade. This separation in job types influences local skill bases, migration flows, and housing demand in very different ways. Financial services now make up a greater proportion of the economy than before the global financial crisis, the deregulation of the 1980s, or the post-war industrial contraction. With that concentration, national growth can appear solid when finance performs well, even if most other industries are stagnant or shrinking. But this also raises systemic risk, vulnerability to shifts in global markets, regulatory changes overseas, or technological innovations that could undercut the sector's dominance. Government revenue shows the dependence clearly. Tax receipts from the capital's financial sector contribute a disproportionately large share toward funding national public services. If this revenue stream fell sharply, no other sector could replace it quickly, leaving the fiscal position exposed. In more balanced economies, downturns in one sector are offset by others. Britain lacks that redundancy. Official reports acknowledge the concentration in careful language, while the public conversation rarely highlights it directly. Outside the capital, winning inward investment is far harder. Regional transport and digital infrastructure often lag behind comparable EU cities. Persistent skills gaps remain, fueled by graduate migration out of the regions. Business parks sit underused, not through lack of facilities, but due to too little local demand to sustain them. Far from closing over time, many of these competitiveness gaps have widened. London's property market reinforces the concentration of economic activity. High demand for premium office space keeps the financial hub anchored in the city center. Even the global shift toward remote work has had less impact here than in many other capitals, and the proximity of law firms, auditors, IT consultants, and specialist suppliers strengthens the finance cluster. This efficiency works for the sector, but also keeps economic power tightly bound to one location. Some voices frame this as a strategic advantage. Britain has found its competitive edge and should double down. The counterpoint is persuasive, that such reliance creates fragility. Other nations with strong financial sectors, such as Switzerland and Singapore, also maintain globally competitive manufacturing, logistics, or technology bases. Britain's weakness outside finance means less capacity to cushion shocks or distribute growth more evenly. The split shapes political priorities. Decision-makers immersed daily in London's success may underestimate the depth or persistence of regional decline. National strategies lean heavily on tools that work in the capital. Tax incentives, tweaks to regulation, partnerships with large multinationals. But these measures have limited use in places without major investors to court. This mismatch between conditions on the ground and policymaker assumptions risks locking in the divide. Migration trends deepen the gap. Young, skilled workers relocate to London for finance or allied roles, draining capacity from their hometowns. Rates of business start UPS outside the capital have dropped, partly because potential founders leave before launching. This removes not just spending power, but also the human capital needed to support local recovery. Over time, low growth deters investment, and low investment keeps growth low, a cycle that becomes harder to break. What is distinct in 2025 is the clarity of the data. With the financial sector's share of the economy at modern highs, there's little ambiguity about the imbalance. London's performance reflects the success of a narrow set of activities in a limited physical area, while much of the country manages ongoing structural stagnation. The greater the reliance, the wider and more immediate the impact if that sector hits trouble. What this means for you: if you don't work in London finance, your career and pay trajectory look much different, and understanding that matters for job strategy and relocation choices. And the effects of this imbalance aren't confined to jobs or wages. They show up in everyday costs that touch everyone, no matter where they live. The housing crisis breaks the meter. One of the clearest ways this national imbalance shows itself is in the housing market, where price trends have detached almost entirely from local incomes. Housing affordability is worse than in most of recent memory. In England, median house prices were about 7.7 times median full-time earnings in 2024, according to ONS figures, making ownership far harder for many first-time buyers. Mortgages that once looked like a stretch are now outright unreachable without significant family support, and even solid professional salaries can't bridge the gap. For younger adults, the idea of buying a home has shifted from a life milestone to a statistical outlier. The usual advice to save for a deposit breaks down when the amount you need rises faster than your savings can grow. Multiple forces push those prices upwards. Demand is swelled by investor activity from both UK and overseas buyers, drawn by the relative stability of British property and its potential for capital gains. In many cases, the priority is asset growth, not occupancy, which keeps the pool of available homes for residents tight. On the other side of the equation, supply is persistently weak. New building falls short of what's needed to stabilize the market. Homes England data for 2024 to 25 shows around 38,308 starts and 36,872 completions, figures that are well below long-term targets. Planning delays, rising material and labor costs, and political opposition to higher density housing all slow delivery further. And the pattern is no longer confined to the capital. Regional centers, once valued for relative affordability, are seeing sharp jumps. A modest terrace in a northern city can now trigger competitive bidding, not just from local residents, but from higher-earning remote workers based in London or abroad. Coastal towns have seen price inflation fueled by second home purchases, putting many properties out of reach for local earners and displacing residents to less connected areas. The result is growing separation between where people work and where they can live, undermining both productivity and community stability. Physical stock quality doesn't necessarily offer relief. Houses with outdated heating, structural issues, or visible damp still attract multiple offers because buyers fear that waiting will only push them further out of the market. Any necessary renovation is an additional financial burden, whether borrowed or funded slowly over years. Conditions are equally competitive in the rental sector. Constrained supply pushes rents up faster than general inflation, and competition for each tenancy can be intense. In busier markets, it's common for landlords to request extensive advance payments. Government statements often point to post-pandemic building activity as evidence that the crisis is being addressed, but the numbers don't support a meaningful shift. Modest additions to the housing stock are quickly absorbed by a mix of population growth, accumulated demand from years of underbuilding, and investor acquisitions. Even modest interest rate increases have not brought down prices in high-demand zones. For those relying on mortgages, borrowing now costs more. For cash buyers, little changes. The shortage of social and affordable housing deepens the divide. Council housing stock lost through sales or demolition has not been replaced at the scale needed, and waiting lists for affordable units have grown to record lengths. Low-income households are often left to source rentals in the private market, where housing benefit payments fill part of the gap, but also help sustain high rent levels. Without significant new public provision, pressure in the private sector remains unrelieved. Property ownership in this climate has become a decisive factor in household wealth. Those who bought before the steepest rises, or who inherited property, have seen their net worth climb without active effort. Those without such advantages face long-term renting or high-debt purchases far from economic centers. In the aggregate, investment is pulled toward holding and trading property rather than into productive activities like business expansion or workforce training, reinforcing low productivity growth. The broader economic impacts reach beyond individuals' living situations. High housing costs reduce labor mobility. Employers in sectors from healthcare to education report difficulty recruiting for roles in expensive regions, as salaries do not match local housing markets. For those who do buy, affordable locations can mean long, costly commutes that eat into disposable income, personal time, and well-being. Urban development schemes sometimes claim to address these needs, but many end up focused on higher-margin units aimed at investors. Marketing materials often highlight projected yields or long-term value gains over local wage compatibility. This turns potential housing solutions into further vehicles for investment, repeating the cycle in which property functions more as a store of wealth than as shelter. Periods of strong international demand for UK property highlight the lack of effective countermeasures. Proposals for higher taxes on foreign buyers or limits on bulk investor purchases are debated, but often softened or delayed. The same factors attracting outside capital, legal stability, currency diversification, and market transparency make it harder for local residents to compete. The ripple now extends into smaller, less obvious markets. University towns see steady conversion of family housing into multiple student lets, squeezing young families out. Rural communities face development restrictions for environmental or heritage reasons that keep supply low. As commuter belts expand outward, demand from urban professionals raises prices, even in areas with weaker local economies, establishing a broad price floor across the country. Rental data from 2025 shows both nominal and inflation-adjusted rents at record highs nationally. Limited supply means landlords can increase rates yearly without losing tenants. Formal rent controls exist only in isolated cases, leaving most tenants exposed to rising costs. A growing share of households spend more than 40% of income on rent, a threshold associated with financial stress. That level of housing expense cuts into retail spending, leisure activity, and savings rates, feeding back into slower local economies. While some officials frame high property prices as a signal of confidence, the distribution of benefits tells another story. Gains concentrate among current owners, while the excluded majority face long-term disadvantages. Various buyer assistance schemes have made limited difference, and in some cases have simply channeled more purchasing power into a fixed supply market, adding to price pressure. By mid-decade, the housing market operates almost as a parallel economy, driven by its own momentum rather than by improvements in productivity or incomes. Underbuilding, investor-driven demand, and policy inertia keep prices high, and small market dips are quickly erased as demand returns. For those shut out, the barrier is structural, not temporary. If you're buying now, consider being realistic on location, weighing the long-term costs of renting versus owning, and exploring shared ownership or new build schemes. But always cross-check local supply and local housing allowance limits before committing. The housing story is one of many places where the gap between policy projections and actual outcomes has grown wide. And housing is far from the only sector where expectations set just a few years ago now sit uncomfortably beside present-day data. Post-Brexit trade, the hangover stage. When the UK voted to leave the EU, official forecasts in 2018 cast the coming decade as a chance to reshape its place in world trade. Gains from faster-growing markets beyond Europe, offsetting any loss of frictionless EU access, were supposed to come quickly. Free trade agreements would be struck on more favorable terms than those negotiated as part of the bloc. Supply chains, it was assumed, would absorb the change with minimal disruption. By 2025, the contrast between those projections and reality is plain. Independent forecasters, including the Office for Budget Responsibility, still model Brexit as reducing long-run trade intensity by around 15% and cutting long-run productivity by roughly 4% compared with remaining in the EU, an ongoing drag on both exports and investment. The EU is still the UK's largest single trading partner, but goods now cross that border with a level of friction most businesses haven't dealt with for decades. Extra certificates, customs declarations, and regulatory checks add time and cost at every stage. For perishable items, such as fresh seafood or chilled meat, the hours lost can shift a delivery from profit to loss. Routes that once ran directly from UK factories to European distribution hubs now require contingency plans for inspections, documentation training for drivers, and often more expensive logistics contracts. For EU buyers, these extra costs make UK products less competitive against alternatives made within the single market. Imports have also become more complicated. Small and medium-sized firms that source components from Europe face higher transport charges, delays, and in some cases supplier surcharges to cover the additional hassle of serving UK customers. While global cost pressures affect many goods, ONS data and industry surveys point to customs complexity as a consistent factor in price increases across categories from electrical appliances to clothing.